Hi everyone, and welcome to Investing Strategies. It's Alissa Coram with Investors Business Daily from the NASDAQ market site in Times Square. With the broker battle for zero commissions, what's the real impact of free trades? We're sitting down with Betterment to discuss, along with a look at key behavioral finance insights for navigating the choppy market. Plus, cashing in on earnings. This week's technical analysis is all about buying breakouts on earnings. And the energy surge. Invesco is here to break down this year's big move in solar stocks and why it could help investors find some visibility amid market uncertainty. Investing Strategies starts now. All right, let's kick things off with our market insights this week. While the stock market is continuing its rebound from early October lows, the rally is facing resistance as it nears prior highs. The NASDAQ composite neared its 50-day line intraday Friday, which is now a key support level. Investors should see if the major indexes can continue to hold above their 50-day moving averages. Will the market be able to break into new all-time highs, or will it move sideways or pivot lower? With earnings season now underway, that could provide a clearer picture of where the rally and top growth stocks might be headed. But one thing's certain, heightened volatility and headline sensitivity persists. And how are investors handling their trades amid the volatility? Here with me now to discuss investor behavior and the reality of zero commission trades is Dan Egan, the Managing Director of Behavioral Finance and Investing at Betterment. Thanks so much for being here today, Dan.
My pleasure. Thanks for having me.
All right, so I think especially the last couple of months have been perceived as being extra volatile for the market. So how are investors handling their trades during this volatile time?
Yep. I think one of the key things to remember, so I work for Betterment. We tend to see a very specific kind of client who tends to be a sort of long-term, not active trader. They're not coming in to speculate. So for the most part, we've not seen much. One of the things that has been different and that I think is more of a modern sort of internet-enabled, always-on news cycle thing is that the news and the relationship to portfolios is sort of more politicized. So one of the biggest divergences we've seen in behavior was, and that has persisted, is since Trump was elected, there was a big divergence. How you thought about the stock market if you were a Democrat became very different than how you thought about it if you were a Republican. If you were a Republican, you became very bullish. If you were Democratic, you became concerned about things. And for every little cycle since then, I would guess that a lot of Democrats have missed out on a lot of the rally that's happened since he was elected. But by the same token, every time there's some news event, especially around trade talks that are highly political, there's sort of a differential reaction where some people get more bullish and some people get more conservative. And it's been interesting to watch that play out, even a little bit inside of our customer base, where people who are living in areas that tend to be Democratic are a little bit more sensitive.
Right, and I think it's interesting how just the headline sensitivity, the minute you think that the bears have really taken hold, we'll just start rebounding higher. So for, I think, a little bit more active traders, it is a little hard to kind of gauge the tone. So what should investors then be doing when there might be all of these mixed signals in the market? Oh,
I mean, that's if you want to try and beat other people's estimates of the market, you're going to have to take on that stress, right? One of the key things is that one of the rise of passive investing, especially low-cost investing, it has gotten easier to trade and sell things, but the market has probably gotten more efficient. There are more computers looking at these things, so it's harder to say that any given individual is going to have an edge that they should be investing in. At the same time, it's never been cheaper or easier to get into a sort of low-cost, tax-managed portfolio.
Right. So speaking about that, October, we now saw all of these brokers going to the zero fee trades, which for a lot of retail investors seems pretty appealing. Heightened competition, trying to get more investor dollars. But what is the reality, do you think, of free trades? Specifically, I guess we can start with the impact on investor behavior.
Yep, it's a good question, right? Is there such a thing as too much of a free thing? And I think it's less a matter of costs have been on their way down for a while. Like, I think brokerage costs were usually at sort of $4 or $5. This was not anything that was going to break the bank. It does mean it's easier and more rational to trade small amounts. But these aren't charities. So how are they making money? What do you need to think about and look out for? Well, one of them that's usually publicized is the idea of payment for order flow. So they're going to take your trade and send it off to somebody who's going to pay them the most margin. That might not be the most execution. Generally, the costs aren't too big. They also make money with sort of premium features like leverage or shorting. But the big one is cash. a lot of them make money on your cash that you hold as cash. And so where markets right now might be paying 1.8, 1.92%, you'll be getting nearly nothing. And that's margin for them. So think very carefully about when you're interacting with a broker who has free trades. They don't have an incentive to have you trade too much. They want you to hold cash. A lot of times their designs will reflect that. They want you to be trading and scared of the markets and end up in cash.
All right, so when we're talking about investors seeing the appeal of this in terms of, oh, well, now I can get a lot more active with my trades, is that almost a double-edged sword, do you think?
Definitely. I think if you're getting started and you don't have a lot of experience, there's less likelihood you're going to really hurt yourself just with the fees and the commissions. On the other hand, if you're bigger, it might be that the spreads are worse now because all of these free trades are getting paid for somehow, and it's probably not clear to you. There's a really good analogy in that it used to be that you would pay for foreign transaction fees. So like you would get a fair exchange rate, but you would have to pay $5 or $10 for the foreign transaction fee. And they said, wait, the foreign transaction fee is free, but we're going to charge you a bigger spread on the exchange rate. And the problem there is that now it's hard for consumers to tell who's actually giving them the best deal. You don't know until after a trade has finished whether or not you got a good execution price or a bad execution price. So I think at a market level, it's actually going to get harder to figure out if you're getting the best deal.
Right. Yeah. So when you're talking about execution, it's one thing if you're trading just a couple of shares, but the bigger of a position that you have, do you think that this is actually a pretty bad deal
Definitely.
for them?
I ran some numbers, and I think once you start getting above $30,000 or $40,000 in a trade, you would actually prefer to just pay $5 and get really good execution compared to pay nothing and get bad execution.
So what are they to do now?
There are some tricks. They take a little bit more ongoing monitoring. You can use limit orders, especially on ETFs, to make sure that you get a fair price. You can also farm it out. So one of the biggest differences in our industry right now is the difference between a broker and an RIA. A broker is effectively just there to perform those trades for you, and they have to do an okay job, but not the best job at it. On the other hand, advisors who are fiduciaries, their actual regulatory oversight as well as their sort of oath that they tend to take is, I'm a fiduciary, I'm going to do what's right for you. You generally don't have to worry about execution if you've got a fiduciary advisor. You do need to worry about it if you've got a broker. So one option is go with a fiduciary.
All right, and you talked about the brokers making money off of your cash. So let's talk a little bit more about cash.
Yep.
How is that been increasingly more beneficial for investors in terms of the mix of their portfolio than perhaps it was in the past with this whole conversation about what's happening with interest rates?
So, I remember back in 2009, we went to the point where cash no longer would beat inflation. There's been an entire decade, an entire set of investors who grew up in a period where cash was just losing you money to inflation at a steady rate. Cash was trash. And they needed to look to take on a little bit more risk in order to make their returns. This was especially painful for retirees who had saved up and hoped that they could just have the dividend yield or the coupon yield pay them out over their retirement. So I think that it's one of the sort of sea changes from the past decade that we're underestimating. Number one, a lot of investors are a lot more comfortable in some kind of a cash instrument, especially if they know it's going to get high yield. They know it's not a bait and switch type thing. So there's money coming off the markets into cash just from retail investors. It also means that any broker or anybody who makes margin on cash has a greater incentive to try and make that margin. The difference between 0 and 10 basis points isn't much. The 0 between 0 and 200 is a heck of a lot. I believe Schwab just posted most of its profits now come from cash margin interest. So I think there's a greater opportunity. It makes a lot more sense now for investors to be aware of what they're making on their cash and trying to maximize the yield for themselves, not for their broker.
Right, and when you talk about investors parking their money in cash over the last decade, it makes me think of the financial crisis. So do you think that, a decade later that investors finally have healed from that, or how does that impact what they're doing with their money, especially when we do hear whispers, I guess you could say, some out there of a recession being on the horizon?
Yep. I definitely think we have sort of a PTSD. If you live through, and you seriously lived through 2008, it sticks with you. And the scar tissue might have healed, but you've not gotten over it. And we're a little too sensitive. We're a little too hair trigger. We have to remember that a drawdown, a crash of the size of 2008 has happened precisely twice in over 100 years. You have basically the 1930s, the Great Depression in 2008. It would be a real change for us to experience those things more frequently. So we're sensitive to it, but it's not necessarily more likely. We're just worried about it more. I think there is an entire generation of investors now who weren't invested in 2008. They've been looking for opportunities to invest. So anytime the market goes down, they get to move from cash into a portfolio without worrying about investing at a high. So there's always two sides to every story about what a trade is.
All right, well, a fascinating conversation. I know that was just scratching the surface of the mind inside of an investor, but thank you so much for sharing your insights today, Dan.
My pleasure.
All right, and coming up next, we're breaking down the chart action for a top stock on the move. That's right after the break.
Leaderboard helps you invest better with winning stocks picked by our team of experts. Select a stock to see current analysis. Check the chart for buy and sell points, plus get real-time price alerts. Improve your investing with Leaderboard. Start your free trial today.
Earnings season is here, which means investors should keep their watch lists fresh with top stocks that are setting up in chart patterns heading into their quarterly reports. While it's risky to buy a stock outright ahead of its earnings results, you should be ready to strike if and when a high-quality stock blasts higher after its report. So let's take a look at an example of a stock that did just that very recently, Intuitive Surgical. Now, the robotic surgery stock surged 7% on October 18th in reaction to a big earnings beat and strong guidance. Earnings climbed 21% for the quarter, while sales increased 23%. Both figures marked 2 quarters in a row with accelerating growth, and that's bullish. Now, the move put shares above a 549.10 buy point from a cup with handle base here. And taking a closer look at the stock on a daily chart, we can see this earnings-fueled gain was accompanied by heavy volume. Now, that indicates support from those institutional investors, and it's always important to follow the big money on Wall Street. Now, Intuitive Surgical was also able to close the day near the very top of its trading range, which is a further signal of strength. Now, Intuitive Surgical closed the day still within the proper 5% buy range, but sometimes these earnings gaps can send shares surging even higher. Now, we normally say that buying a stock when it's more than 5% above a proper buy point would be considered chasing a stock, but because these earnings gaps can be so powerful, that's an exception to the rule. IBD's research shows that moves like this are often the precursor to even more gains. Investors can also utilize intraday charts to help them with these trades. Now, it's ideal to see the first 5-minute bar of an intraday chart look strong, and you can also use a climb above the first hour high as your signal to get in. So let's quickly recap. Look for stocks with a track record of strong earnings and sales growth that are already forming proper chart patterns. Rather than buying ahead of the report, it's key to wait and see how the stock reacts to the results. If shares can blast higher, look for heavy volume and a close in the upper half of the trading range for the day. It's always important to be aware of broader market conditions to ensure you're in a good environment for buying stocks, but in general, by focusing on these earnings gaps during earnings season, you're able to minimize your risk and capitalize on the momentum of a big move higher. All right, well, coming up after the break, we're going to discuss the resurgence of solar stocks with Invesco. We'll be right back.
This season on Cultural Capital, we are in New York City and San Francisco. Come with me as I tour some of the world's most innovative companies, from Squarespace to C3 AI, Giphy, and Figma. Learn how CEOs built growing companies while maintaining the ultimate office culture on Season 3 of Cultural Capital on the brand new NASDAQ.com.
Now, the solar energy industry has been on fire this year, with that group gaining a collective 30% year-to-date as measured by the Invesco Solar ETF, TAN. That's versus the S&P 500, about 19% gain. Here to share insights about what's behind the move is Jason Bloom, the Senior Director of Global Macro ETF Strategy at Invesco. Thanks so much for joining me today, Jason.
Thanks for having me.
So, solar has seen such a big move this year. What do you attribute to this group's strength?
I'm happy to report that the strength is really the result of stock prices following fundamentals. If you were a fan of solar at all in the last 10 years, you probably remember some very disappointing performance numbers. And if you think back 10 years ago, everyone that predicted the explosion of the solar industry was right. What they were wrong about was how difficult it was going to be for these companies to be profitable while they were gaining economies of scale and during a period of such rapid technological advancement and innovation. So competitive pressures have made profitability difficult, but the sector is growing just as fast, and in fact faster than people thought. And really what we've come to is a period of time where prices are stabilizing for the manufacturers. So now they're growing unit volume every year. They can actually start to grow top line and grow profitability because the prices for their goods sold are stabilizing. They're still falling year over year, but just dramatically slower rates, not the 20% year over year declines we were seeing for probably about 8 or 9 years as the industry sort of gained critical mass.
Right. It does look like there are improving fundamentals, although it doesn't look like yet we really have that solid quarter over quarter on a continual basis of that growth. What do you think it's going to take for it to get there? I mean, you mentioned the price stabilization. That seems key.
Right. If we continue to see that sort of somewhat stable, or at least relatively stable environment, maybe not stable compared to other industries, but certainly compared to solar, if we continue to see that stabilization in the pricing, and I think we will, because solar is now competitive with fossil fuels on an unsubsidized basis. So we've reached that point where politics, policy, subsidies, tariffs, they have an impact, but they're not crucial to the long-term success of the industry at this point. They're really more headwinds or tailwinds with respect to growth rates. So I think that we're going to see what we've seen currently continue into the future. Now, there's still some sensitivity to global GDP growth. So cyclical factors will contribute to volatility as well. I think one of the things we can probably rely on going into the future is some volatility, right? We've maybe not as much as we've seen in the past. Now the fundamentals have stabilized, but it is a mid-cap, small-cap dominated portfolio, and it is somewhat headline-sensitive portfolio. So yeah.
Right, and you mentioned it being competitive with fossil fuels on an unsubsidized basis. I think a lot of investors might actually be surprised to hear that. I feel like that's not talked about very much.
Well, there's a lot of sort of emotional debate in the marketplace over, policies to transition towards renewable energy. Obviously, that's painful for some parts of the economy, and it's profitable for other parts of the economy. And in the midst of that debate that can sometimes become somewhat political, the actual fundamentals have, well, it's recent news, right? And so the fundamentals can get buried in that political debate, but it's true. The cheapest bid new electricity generation in the world now is solar in those parts of the world that have adequate sunshine.
Interesting. Yeah. So you mentioned government support for renewable energy and solar being a big part of that. Do you see that still continuing to be a part of the story moving forward for solar?
There's certainly, again, some headline risk along the way. Certainly in the U.S., there's a robust debate about subsidizing the transition to renewables. But if you go outside of the U.S., there's not much debate. In Europe, policy very strongly supports the transition to renewables, even at the sacrifice, right, of growth in the short term in some ways. In Asia, you're seeing the transition to renewables both on from a policy standpoint also, but from a pure necessity standpoint. When you look at air pollution in some of those really highly populated cities, they have to bring down the particulate emissions. And electric cars, solar power, wind-generated electricity is the way to do that. If you look at the growth rates over the last 10 years in solar and then the projected growth rates over the next 10 years, they actually have been, the forecasts have been fairly accurate. As I mentioned, the profitability forecast was the tough part. But solar is now forecast to grow between 10 and 13 times over the next 20 years. It's a much faster growth rate than GDP. Really anywhere in the world. And so as a sector over the long term, the prospects are really positive. short-term volatility, though, is probably going to persist.
Yeah, let's talk a little bit more about that, because this year has been fantastic. I think there was also 2012 to 2014 was also a really nice period for this group. But when you take a step back and look at the long term,
Yes.
It's been very volatile. So do you think that that requires investors to be a little bit more tactical with their timing when playing this group, or how should they kind of reconcile that volatility aspect?
Well, with respect to today's pricing, valuations are still pretty reasonable. Again, we've seen a huge surge from losses to profitability, and so when you look at PEs, they're not rich by historical standards. On the other hand, most of our clients, we do not advocate trying to trade the market. So if you don't have a solar allocation now, but you're looking at adding one, averaging in over a period of time is a really nice way to take the pressure off of, buying a short-term top. So, yeah. But
Right.
I think so. Right. So averaging in is probably the best way to do it. We really try not to time the market.
Right. Okay, so let's talk a little bit more about the ETF itself. It's an index tracking ETF. Can you tell me a little bit about the methodology behind that? I mean, clearly across the board, it's a lot of solar names that our audience is familiar with at the top of the holdings, from SolarEdge to First Solar. But tell us a little bit more about the makeup of the ETF itself.
Sure. It's a highly concentrated on it's an attempt to be a pure play solar portfolio. So any company that has 2/3 or more of its revenue generated in the solar sector gets a full weighting in the portfolio. There are other firms that contribute critical technologies to the solar industry, but if that solar business is less than 2/3 of their business, then their weighting in the portfolio is cut by a factor of 50%. So the attempt here is to really get you concentrated exposure to the solar sector. From a geographic standpoint, it's about half US, half international. China would be the second highest weight, and then you've got some developed European countries in there as well.
All right, and then in addition to this ETF from Invesco, there are also new products that you guys are highlighting, right?
Yes, so TAN has been in the market for a very long time. We recently launched the latest suite of the BulletShares target maturity ETFs. We previously had launched investment grade corporates and high yield corporates, and a few weeks ago we launched the municipal suite. Was something that we've been anticipating for a long time. We've had a lot of clients request us to launch the BulletShares structure in the municipal asset class, so we're pretty excited about that. We've had a lot of very positive conversations with clients. The BulletShares, at the end of the day, as you know, I'm sure, but maybe some of our audience is not familiar, they're simply an ETF that holds bonds to maturity. Each ETF holds bonds that are expected to mature in a specific calendar year. And then when that calendar year finally comes and we pass through it, the ETF actually matures similar to an individual bond and returns the proceeds back to the investor. So it's an investment experience very similar to holding a bond to maturity, but you get immediate diversification, you get exchange traded liquidity, you get very low cost exposure. And those are benefits that are probably prized in the municipal asset class as much or more than any of the other sub-asset classes in fixed income.
All right, well, thank you so much for highlighting that for us and for going into detail on what investors really need to know when they're investing in the solar space. Thanks so much.
Thanks for having me.
All right, and thank you all for watching Investing Strategies. We'll see you right back here for our show next Monday. Until then, I'm Alissa Coram.